Hi everyone, welcome to MC the Accountant Shares. For the previous two episodes or sessions, we discussed about installment sales method, basic concepts. That's on the first. Second was on still installment sales, but with computations. We had 2-year periods and reconstruction of information. For today, it will be the continuation of that, and this is focused more on items for installment sales with present value. So basically, this would be about installment sales that are made on account, long term, and evidenced with promissory note. All right, so the discussions might be very long, guys. However, despite the time that I consume in discussing, I may not be able to really dig deeper into a lot of things. So, in other words, it will be our tasks now to broaden our knowledge with other materials available with us. All right, so as you can see, that's the present value. And here are the present value formulas. So just to be able to really emphasize that this is with the inclusion of present value on the concepts that what we have learned so far. So make sure that you are able to really go back if you have forgotten the previous two episodes involving installment sales. So this is the present value computation as a review. If there is a lump sum or one-time payment, you call this PV of 1. However, if there are series of payments, which is really true for installment sales, which are really long-term, evidenced by promissory notes. So in other words, installment notes receivable. So you can see here in the denominator, the computation of the present value factor for annuity. Okay, so let's begin. As discussed last time, we will begin with present value. So if you say present value, basically from the word present, that is the value of an amount that is to be collected, in this case, on the part of the seller, collected in a future time at time 0. So if we will be collecting 1 million 2 years from now, what is the value of it at today or at this time, at time 0 or t, which is time equals 0. So that is present value. Now, when we are selling our products, of course, it is but normal that with the three types of sales, remember, cash sales, credit or account sales, and installment sales, there would be changes or variations of prices. For sure, the lowest one would be, for sure, you now have an answer in your mind if I'm asking this question. The answer must be the lowest among the three in terms of prices would be cash sales because the payment is done outright. So it is very normal that even discounts could be given, thus lowering the prices. Second would be account or credit because the term is just shorter, although it is made on account. It's even possible that it is without interest or with interest. And the third one for sure is installment sales, wherein it's going to be really the highest because it's going to be in different periods. So let's say 12 months or 24 months or 36 months. So for sure it's going to be long-term perspective, more than 1 year in that case. And normally for installment sales, which are expressed in notes with promissory notes, it's going to be in series of installments, say for example, monthly or even quarterly, semi-annually, or annually over a certain number of years, depending on the contract. So when the collection of sale price is extended, the seller is providing the buyer a means of financing because the buyer doesn't have to pay it immediately, so the buyer can make use of whatever asset is acquired without paying it yet and can use that in business. And because of that, we have to charge a seller's finance cost. So this is why the selling price is higher, because interest is also added. The finance charge is the interest, of course. So this is one way for us also to earn in the contract, aside from the gross profit that we basically charge on top of the cost. Now, mind you, or mind us guys, that the interest here is another item, which is interest income, an income item. Now, however, for the purposes of computing realized gross profit, we have to remember that the collections is exclusive or are exclusive of interest. In other words, interest should not be included in computing realized gross profit. However, it is part of the income or the total income of the company. We then say that, in other words, there would be three items now for income. First one is the gross profit coming from regular sales. When we say again regular sales, we mean cash or account sales. And then those two, whatever the gross profits, will be realized. That's under IFRS 15. The second one will be realized gross profit under installment sales method, as we have discussed. And the third one would be interest income, if ever there would be interest for the installment sales. So that's what I've already emphasized. And the deferred gross profit is based on the present value of the remaining cash flows. But then that is still going to be exclusive of interest. If we mention again gross profit, we have to be sure that they are without interest. Here is an example. So selling price is here, 2,200,000, and you have here the cost. So there's down payment, then equal annual installments of 252,000, and this is the imputed rate. Now, there is no mention as to whether the contract is interest bearing or non-interest bearing. In our financial accounting and reporting, remember, we are going to really think that in a particular situation that the problem is silent, it's going to be, when you say, or when we say, by the way, problem is silent, meaning it's not stated as to whether there is interest bearing or non-interest bearing note. However, in this particular situation, there is a mention of imputed rate of interest. When you say impute, meaning we are going to charge or extract the interest out of the particular type of sale or the amount of sale. So that's why, in other words, you really have to compute the present value of this particular note. So here are the requirements. First is gross profit based on sales. So as we all know, when we compute gross profit rate, that is the deferred gross profit over the sales or installment sales. And then if ever, for example, we will be asked how much is the deferred gross profit, that is sales or installment sales, minus the cost of installment sales. By the way, there is really an emphasis on attaching the word installment on sales and accounts receivable, as also with the cost of sales, to differentiate installment from the other types of sales, regular sales. Okay, so how do we compute down payment? That's given. And then good thing, because the annual installments are already given, so all we have to do is to multiply whatever installments that we have with the present value factor. It's going to be 5 equal annual installments, so that would be ordinary annuity of 1. Ordinary annuity of 1 because the first payment is to be made a year or a period after the transaction date. Transaction date is January 1, 20X1, and then the date after that, the first payment date or collection date in our case, because we're again the sellers here, so that is after a period, meaning that's going to be ordinary annuity. So as computed, the present value of ordinary annuity at 10% for 5 periods is 3.790 ... So how do we compute this one? Again, we can go back to the picture. That is the present value factor is 1 plus R over N. So R is the rate divided by N is number of periods in a year. That was annual, right? Annual. So meaning that's going to be still at 10% because annual means the denominator is 1. 10% over 1 is 10%. And then the power is going to be the number of years times n. N is the number of periods in a year. T is 5 times 1. Any number multiplied by 1 equals the number. So if we multiply the present value factor with the installment or the installment, then we will get this one, the present value of installment payments. And if we get the total, that's really the sales price exclusive of interest. This is still without interest. Okay, so anyway, to continue, you have here sales price exclusive of interest. And then why are we using this one? We are not using 2,200,000 because this would be the installment sale price with interest. We said exclusive of interest when we compute the gross profit. So you have here, then this is the gross profit and divided by the sales price exclusive of interest, so that the answer would be 56%. Okay, and then as being discussed in our financial accounting and reporting, we can actually make an amortization table for us to be able to easily compute the amounts without or exclusive of interest. So you can have, or we can have 5 columns: date, collections, interest, income, amortization, and present value. The present value is basically at the start, whatever was the sales price here. Then collections would be the down payment and the regular payments 1 year thereafter. And then the interest income is whatever is the present value prior, meaning the unpaid balance, multiplied by the rate, which is 10%, equals the interest income. You can notice here it's 0 simply because this is still the same date. So to compute interest, that's interest equals principal times rate times time. At time 0, so T equals 0, any number multiplied to 0 equals the number. Okay, so we are now ready to place the figure here. Collection 0, then amortization is also known as reduction to principal in other books. So collections minus interest income equals amortization or reduction to principal. Now these amounts are the amounts when multiplied with the rates would be equal to realized gross profit, not this one, because this one is still with interest income. Then present value is basically whatever was the previous balance of present value, also known as carrying amount or value or book value, minus the amortization equals the present value. So you can check that out. This amount minus this equals this one. For 20X1 ending December 31, that's or ended, that's going to be this one, 1.3 million plus minus 218,564 equals this amount, and so on. For the last year, it should be 0. So probably we can do some rounding off of numbers just for us to be able to really get the exact figures. However, because we did not round off the present value factor, that is the reason that we are exact here at the end. So that could be tackled in other areas, like, for example, mathematics of investment, also in this channel, and also with financial accounting and reporting. We might have the opportunity to go over with such. Anyhow, so hopefully that's clear. As what I've said, amortization will be the basis for our realized gross profit. So for 20X1, that's going to be this amount plus this amount. So Total for this amount times 56% equals the realized gross profit. Now for 20x2, it's going to be this amount again, amortization or reduction to principal, and times 56%. If we will be asked for requirement C, which is profits in 20x1 and 20x2, that's going to be here. You have the interest income, realized gross profit. You have here the total profit in 20x1. In 20x2, you also have that. Probably the question here is how much is the income? I would say not profits, because we have to be careful. When we use the word profit, that's going to be net income, right? And that's going to be whatever is the total income minus total expenses equals profits. I think this should be changed. This should be compute for the total income in 20x1 and 20x2, or revenue. That could also be used. Anyhow, so what about deferred gross profits at these two dates ending 20x1 or ended 20x1 and 2? So as what I've said, forgive me for moving the mouse too much. So as what I've said, again, it's going to be amortization and the remaining balance. So how do we compute for 20x1? For 20x1, if this is going to be the total collection, so this would be the present value end of 20x1, right? So the question would be, how much would be the balance that would be multiplied to the rate to get the deferred gross profit? So you have here, whatever was the present value of the note multiplied by the gross profit rate equals the deferred gross profit. All right. So, some would be saying that, isn't it we are going to extract interest from this amount? Actually, we have already extracted. So, for example, for 20x1, this was the interest. So, the interest that accrued for that year was already removed for us to get this. In fact, when we deducted amortization here, this is already net of the interest. Therefore, this amount is net of interest. So we can simply multiply these and these amounts to the rate so that we will get the deferred gross profit. So let's check. Okay, so 1 million plus and 800 plus multiplied respectively by 56% to get the deferred gross profit balances. Okay, so that's it for our illustration one, present value. That's still the beginning. Let's move on. What about illustration to amount of periodic payments? So a while ago, we are given the payments. For this one, we have to compute. We are given a down payment, and we have to pay 5 equal annual installments a year after the date of sale. So meaning ordinary annuity of 1. The other one is annuity due, wherein it's going to be on the same date. There's already collection that is done. So let's see. We will find out as to what would be the possibility. As we have that problem, we are going to discuss. So anyway, we have here the cash sales price. So in financial accounting and reporting, we are going to compute the present value if the cash sales price or the cash price equivalent is not given. Meaning the priority would be the cash price equivalent because that is the fair value. In the absence of the fair value, we compute the estimated market value, which is the present value. And that's the time that we are going to make use of the imputed rate of interest, which was true in the previous problem. But for this one, this is given, so meaning we have to respect the problem. So we have the cash sales price or equivalent that we use. And this amount, again, is exclusive of interest. So to be able to compute the periodic payments, whatever's the down payment will be deducted, and we divide that by PV of ordinary annuity of 1 for 10% for 5 years. And we get 352,000. Oh, quite the same in the previous problem. I like it because they're connected. Then installment sales price, that's going to be down payment and the total periodic payments. Okay, 252,000 times 5, we get 2,200,000, which is connected in the previous problem. If we want to dissect 2,200,000, so this one is with interest. Okay, so if we would like to know how much is the unearned interest income at time zero, let's go back to previous problem. We can actually compute. We are given here the sales price exclusive of interest. If we deduct 2,200,000 with this one, that's going to be the total interest that will be earned over the term. And then that will be the unearned interest for now and will be considered as interest over the 5 years. Okay, so another one is we have here, what about present value for 2 years? Okay, so this could be challenging. Anyway, I'm excited. So we have here the 2 years and then exclusive of interest, collections, imputed or effective rate of interest. That's true. The imputed rate of interest is the so-called imputed or effective, meaning the prevailing market rate of interest at that time. So there's in fact even an author saying that if the problem is silent, meaning no mention of the rate, we assume it is at 12%. Unless we can extract the rate. That's also an exception. But then if no mention, really, we cannot really determine, so at 12%. The sales were made at the beginning of each year and collections were made at year end. All right, so meaning annuity. This is going to be an emphasis on annuity. Question is how much is the interest income and the total realized gross profit? So in this case, for 20x1, then we make amortization table. The interest income is this amount. For 20x2, by the way, so 20x1 will have an interest income. That's a sale for 20x1 and in the year 20x2 also. So in the year 20x2, which is asked here, that will be the interest income that we are going to obtain. For 20x2 sale, that's going to be just 1 year end. So this is the interest income. And therefore, the total interest income would be the sum of these two interests or the interest income. Okay, what about realized gross profit? Since we have already made two tables, by the way, how do we know that we really have to make tables? There was no mention of promissory note. If you really see interest here and imputed, that's really an implication that we really have to discount or consider present value factors. Okay, so you have here also the collection in 20x2 from 20x1 sale here. And, oh, this should have been December 31, 20x2. That's why. This is 20x2. Then this one and this one. To be multiplied to the respective rates, we have here 40% and 45%. So 600,000 plus times 40%, okay, and 700,000 plus times 45%. That would be the total realized gross profit. Hopefully that makes sense. The lesson here is that if there are 2 or more years for the sales with interest, so all we have to do is to compute also separately tables of amortization for the different years. So in this case, it is assumed that probably there is just one contract per year, but we really know in real life that there could be tens, hundreds, thousands of contracts, most especially if we earn, or our business model is that we earn a lot from installment sales. So in that case, that's going to be contract per contract, especially if you have different gross profit rates. Anyhow, reconstruction of information for present value. So gross profit rate, collection, and this is with principal and interest, deferred interest income. Question is, how much is the realized gross profit and the sale price exclusive of interest? If this is the deferred gross profit ending, if we divide this by 45%, that's going to be the present value, right? Anyway, yeah, that's it. So that's going to be the present value of installment accounts receivable. And then if we plot that on the amortization table, which is partial, there's a word partial because this is just like a year. And the contract is good for how many years? It's not stated anyhow. Moving on. So we work back, we squeeze. So interest income as given is placed here. Collections is given also here. So this would be the amortization. If we get this one, supposedly that's going to be present value of the previous period minus the amortization or reduction to principal. Since this is to be obtained, so we add back and we get the present value. So this is going to be the letter B, right? Sales price exclusive of interest. And then if we are asked the realized gross profit, we have here the amortization, and we multiply that with a gross profit rate. Yeah, that's it. Okay, so we are getting better and better. Now let's check how many okay, so we will stop at illustration 6. Reposition will be the next items. Reposition and trade in. So illustration 5, interest bearing note. So you have here ABC company uses installment sales method. Okay, so yeah, that's the business model, selling equipment in installment sales. We allow this normally in business because the price is huge and not everyone can afford to have it in cash. Okay, so 200,000 down payment and 10% note receivable for the balance. So question is, how do we know that this is interest bearing note? That could be the question, right? How did I know? Because of the wording or wordings here. Received a 200,000 down payment and a 10% note receivable for the balance. In other words, the down payment and the installments that will be received at 200,000 will be without interest or exclusive of interest yet, meaning the interest is to be added on top. If this is non-interest bearing, supposedly the installment will have it or will have together with it the interest. So it's a simple conjunction which is and that spelled already everything in the problem. All right. So how do we compute? Still, we are going to make an amortization table if we will be asked like long term, since it is for equal annual installments, but since the question is just 1 year, so we can just disregard the amortization table. So what is good and what makes the life easier for interest bearing note is that whatever is the selling price, that is already the present value. That's what I've said. So I repeat, if non-interest bearing, what we are going to do is that check if there is cash price equivalent. That is the fair value. So if given, we have to use it. If not given, then we are going to extrapolate or extract or obtain the amount of the present value of the receivable or installment receivable. And then if it is going to be, or if it is an interest bearing note, so the interest bearing note will have the selling price as already the present value factor. No need to discount. So that's why 1 million minus 200,000. What is asked here is the deferred gross profit. So basically the ending balance of notes receivable. So 800,000 minus 200,000 equals 600,000. Where are we getting this 200,000? That is the first collection to 80 with the interest. See, inclusive of interest. The collection is with interest, therefore this is interest bearing. How is this obtained anyway? 80,000. That is 1 million installment sales minus 200,000 down payment. Therefore, we have a balance of 800,000 at the beginning of the year. we multiply that by 10% equals 10% rate equals 80,000. So we have here 800,000 minus 200,000 equals 600,000 times 25% equals 150,000 pesos. Okay, so hopefully you've got the points. And this would be the last problem for this session. So illustration 6 is interest-bearing note, total cash collections. So same problem, how much cash was collected? We have down payment. Then this is 20x2. So down payment was in 20x1. And then one payment out of the four. So 800,000 divided by 4, 200,000 each year. So in 20x2, you have 200,000. And also we have to collect the interest. The interest is in January 1, 20x1, we have balance of 800,000. And then minus the 200,000 installment in 20x1 equals 600,000 times 10% equals 60,000 for a total cash collections of 260,000. What is good in interest-bearing note is that it's not going to complicate things in terms of computing the balance, because all we have to do is whatever was the balance prior without interest, we are just going to deduct and deduct whatever installments are there. Unlike with non-interest bearing, wherein there is really a need for us to have the amortization table to avoid confusions, especially if we wanted to know how much really is the interest income, amortization, and the balance. All right, so hopefully you learned something from the session today about installment notes receivable, both interest bearing and non-interest bearing. Please subscribe to my channel, like this video, share to your friends and everyone who wants to learn accounting more the easiest way possible. You can also suggest for other topics that we would be discussing more or further on. And I'll see you next time. That's it for now. Bye.